When headlines appear to drive performance, it can be easy to forget the broader context of current market conditions and expectations. In turn, investor behavior in financial markets is often guided by sentiment, and the fundamentals of sound investment strategy are often ignored. That's one fundamental we never lose sight of. I'm Mark Kinney, Chief Investment Officer with Newport Private Wealth, with your third quarter update. We can't begin this review without first expressing our profound shock and sadness in the wake of the recent Hamas attack on Israel. The senseless loss of innocent lives and the ongoing conflict are deeply distressing. Our thoughts and condolences are with our clients, their families, and their friends who have been directly affected by this tragedy. While there are no words that can alleviate the pain we are all feeling, we stand with you in denouncing terrorism in all its forms. While this conflict is recent, economic shockwaves have already been unsettling volatile markets. Our investment focus remains on strategies that provide income, growth, and diversification. We assess trends in economic data with a view to long-term protection of your capital. While our mandates faced challenges during the quarter, our multi-asset portfolios contain the impact of market volatility. The Newport Balanced mandate limited its decline to just 0.6% compared to its benchmark, which lost 2.75%. Year-to-date, our balanced mandate stands at a positive 2.56%. Let's break down the asset classes that comprise our mandates, beginning with bonds. The bond market continued to face headwinds. Bond yields rose significantly in the quarter, causing 10-year U.S. Treasury bonds to post negative returns. A third straight negative year for the benchmark bond would be an unprecedented event in its century-long history. The prospect of higher yields and potential capital gains has now made bonds compelling. Interest rates at current levels offer the opportunity to lock in yields not seen since the 2000s. During the quarter, we allocated an additional $30 million to this asset class, bringing our total fixed income allocations for 2023 to $55 million. We expect to add more to this asset class. Assets such as private debt, income-generating private real estate, and mortgages contribute to both income generation and capital appreciation. They also serve as a buffer against market volatility. We made several new commitments this quarter to institutional private investments, including the following. Regulatory pressures have created a need for some credit-worthy borrowers to seek financing in the private market. We committed $20 million to a manager in the mortgage sector that has developed a new offering to capture this opportunity. We allocated $15 million to a Calgary-based manager with a focus on private equity investments in the Western Canadian oil and gas sector. Their emphasis on private companies with production and resource growth potential positions them well for premium pricing upon sale. We continue to make steady allocations to one of our managers specializing in multifamily properties. Our $12 million investment enabled the manager to acquire properties in the southern U.S. from over-leveraged developers and operators. Current conditions create long-term opportunities for experienced and well-capitalized firms such as this one. We initiated a new $10 million investment with a manager investing in the redevelopment of mid-sized multifamily properties in the Greater Toronto Area. This move complements our existing private real estate portfolio. Let's move on to public equities. As September unfolded, its reputation of being the worst month for equity markets proved well-founded. Rising interest rates put pressure on the valuation of growth stocks. This led them to underperform their value counterparts and the broader market. The Magnificent Seven tech stocks retreated in Q3, but have still been significant market gainers year-to-date. This is noteworthy because it highlights the divergence between the performance of a wide array of companies and the dependence on a select few that have driven market gains so far this year. More cracks emerged as companies struggled to meet high earnings expectations due to weakened demand, increased operating costs, and higher borrowing costs. With these signs of market weakness and volatility, we paused on making further public equity allocations. With our public equity weightings at the lower end of our historical ranges, we anticipate using this recent pullback to restart our practice of consistent and regular allocations to our public equity managers. Of course, no economic update would be complete without a word on the three topics that have fueled broad speculation: the outlook for inflation, interest rates, and recession. Inflation is causing wage disputes and affecting consumer behavior, which in turn impacts markets. Inflation remains a major concern, driven by rising crude oil prices and stubbornly high food costs. This effect is having an outsized impact on central bank decision-making. We see inflation pressure moderating but remaining above central bank targets. Early in 2023, there was consensus around lower interest rates this year, but this has shifted to a view that rates are not likely to decrease until the second half of 2024. This shift came as a response to persistent inflation. The expectation of higher for longer interest rates is now prevalent. The outlook for a recession appears to have diminished. This has led some to believe that a potential recession has been postponed, not canceled. Time will tell the full story, as will leading indicators for the balance of the year. As one of our fixed income managers noted, recession risk may increase as the year progresses given the maintenance of restrictive monetary policies. While today's headwinds may not go away in the short term, we hold a degree of optimism for the balance of the year. We'll keep a close watch on the potential impact of higher interest rates and inflation on asset prices and the broader economy. These challenges aren't unfamiliar to our team. With an average of 28 years of business, professional, and investment experience, Newport's investment committee has successfully navigated numerous market cycles. Our commitment to remaining patient in challenging markets is unwavering, grounded in the belief that sound investment principles yield good results over time. Consistency is essential in this environment with a focus on stability and predictability of cash flows. Rest assured that you are in safe hands with Newport. It is an honor to safeguard your wealth, and we are grateful for your continued trust and support. As 2023 nears its conclusion, we extend our best wishes to you and your family for a safe and healthy remainder of the year.